it becomes a little bit more complicated when we're paying down something like a mortgage. So obviously you pay down those higher interest forms of debt first, but once you're down to a mortgage as your last form of debt or a student loan, but a mortgage is probably the best example because you have the tax deductibility of interest. How do you make that decision about whether to pay down that mortgage balance?
I think it's a personal choice for people. I think that, at some level, if it's 4% versus 3%, it comes down to, like, would you rather have a paid off home versus invest more? And I think that there isn't necessarily one right answer for everyone, but today it's hard to invest and get a high rate of return. So right now I think it's a great time to kind of ask yourself, what are my liabilities? Would I prefer to be debt free or save more for other goals?
Well, that's true, but that gives you a certain amount of flexibility in the remainder of your budget if you maintain that housing debt at a relatively low cost. So really you're looking at, what is the opportunity cost of investing some of your portfolio in bonds that are maybe returning 2% per year if you have a mortgage that's 3.5% or 4% per year where you can get a certain higher rate of return on your investments. Does it make sense to pay it off early? Obviously, if you're in a higher tax bracket, then it makes a little bit less sense because after tax, the amount of money that you're actually paying in interest is maybe not that high. And also, if you're investing your bonds in a tax shelter type of account, then you get that tax bump as well. So basically, it can make sense for higher cost debt, but when it comes to a mortgage, then it's not quite so easy. And I think I agree that a lot of it is behavioral. I hear all the time people saying, I paid off my mortgage early. I feel much more secure at the age of 50 or 55. If I go into retirement knowing I don't have that liability hanging over my head, that gives me a lot more budget flexibility.